Hey investor, welcome back to the DGI Talk Show, which stands for Dividend Growth Investing. I'm your host Reese, and today we're talking about JNJ. Johnson & Johnson is a massive multinational corporation that develops medical devices, pharmaceuticals and consumer packaged goods. They are currently near their all-time high. If we look at the 52-week range on the Seeking Alpha website, it's basically up there with their all-time high. They currently pay a $4.04 dividend, which is a forward yield of 2.57. Now let's look at their financials. So we're on the income statement now. The first thing we look at is their total revenues. We want to see if this is on a trend upwards, and if we see this is all in millions, and TTM stands for trailing 12 months. In 2016 they had 70,000, and then it just keeps going up and up. Pandemic has hit them a tiny bit, but still producing quite a lot of revenue. And then if we look at operating income, again going upwards, just like consistently at that 20,000 ish mark. Again, tiny hit, but nothing too crazy. Then if we look at earnings from continuing operations, this is the highest so far this year, which is absolutely brilliant. And like in a pandemic, you'd think they'd take a massive hit, but no, they excelled. They've done a really good year for continuing operations. Net income is next. Again, highest year to date in the last 5 years. Can't complain about that. They had a blip in 2017. I'm assuming they just paid off some debt, or they just had a lot of expenses to pay in that year, but otherwise it's quite good. Then we'll move on to normalized diluted EPS. This is the EPS which is taken into consideration all the stocks outstanding, and it divides by that. Just a solid, consistent $4 mark. Some years it's towards the high end, 2018, 2019. This year it's dropped down a bit, but still consistently high. Now, the payout ratio. This isn't the most accurate thing in the world, so I'll show you later on the calculator what their actual payout ratio is. It's close to this, but it's not exactly that. I don't know what happened in 2017, but hey ho. Okay, so I've jumped onto their balance sheet now, and we go straight for total equity. This is the one we look at. What's concerning about this, what you want from a company is you want the equity to keep going up. That means you know they're growing, they're developing, and they keep enhancing the business. But in this case, in Johnson & Johnson's case, they're on the downward trend. I'm not entirely sure why is that. Something to take into account when considering to buy this company. This trailing 12 months is bigger than the last 3 years previous, but still relatively on the downward trend. Then we look at cash flow. Cash flow is king. Cash flow is what pays the dividends. So we've already looked at net income. Now we look at cash from operations. Again, just on the trend of going higher and higher every year. Taking a bit of a hit again because of the pandemic, but still high. And then we go to levered free cash flow. This is the number after everything. This is the money they have left over to pay their dividends. Levered cash flow, as you can see, it's just going up. This trailing 12 months, even with the pandemic, it's the second highest in the last 5 years, which is amazing. And then free cash flow per share, it's brilliant. Again, second highest in the last 5 years. And this exact number is what they pay their dividends with per share. So if we pull up their dividends, so they currently pay a $4.04 dividend. That's the money left over to pay the dividend. If we pull up a calculator here, so $4.04 divided by 6.95. 58%. That's their payout ratio. So well and truly safe. Can't complain about that. That's nothing to be alarmed about. I'd say anything above 70% is where you get a bit risky. You try to ask some questions about that, but 58% is safe. Do not worry about that. So we'll look at the dividend scorecard here. We've got 58 years of dividend growth, which is absolutely incredible. It's one of the highest out there for their long outstanding growth in dividends, which is incredible to see. Growth rate has slowed down a bit in the past years, but 6% is still solid, well above inflation. The dividend yield, again, is still solid. What a savings account right now can only maximum, say 1%, if that, if you're lucky. So 2.57% for a dividend yield, can't complain now. Payout ratio, as we said earlier, 58%. It's definitely safe. At the end of the video, I'm going to give you guys a bonus tip. Use the Chowder rule. What this is it takes into consideration the dividend yield and the growth rate. So if I just pull up an infographic, so I'm on the Instagram for this YouTube channel, It's just DJI Talk Show. Give it a follow if you want. I'd really appreciate that. You can use these rules to decide if the stock has good potential for dividend growth rate as well as a decent yield right now. So in the case of JNJ for this video, this is why it's in the infographic below. It currently has a dividend yield of 2.57, so it applies to Rule 2, which is less than 3%. So Rule 2 suggests that the yield must be greater than 15% for the 5-year dividend growth rate. In this case, it's 6.17, which is on the low end side. So Chowder rule for this stock, JNJ, is 8.74, but Rule 2 implies it needs to be greater than 15%. It's just one tool I use to decide if a stock is a buy or not, and this is one of the reasons why I personally don't invest in JNJ. They don't have a massive growth potential. If you bought them back 20-30 years ago, the growth potential was huge, but then they're at the point now where they're just massive. Like, they're so big, it's just hard for them to grow without just buying out companies. So that's the Chowder rule. Okay guys, I'm gonna end it there. I hope you guys have enjoyed. If you have, can you please subscribe, hit the like button? It really helps the channel grow out. I've just launched an Instagram. If you could follow that as well, that'd be brilliant. And see you guys in the next one. Cheers.